What is going on, guys? Today we are going to be talking about credit spreads in options. Credit spreads are a great strategy because you're able to collect some credit up front and you know what your risk is before you even play the play, and you kind of already know where the stock has to go in order for you to make your money, assuming you don't get assigned, because you can get assigned on the contract you sold if it's in the money. So you got to always be aware of assignment, but other than that, there's really no risk to credit spreads. So before we get into credit spreads, I just want to give a fair warning because I feel like a lot of people freak out about this. When you do a credit spread and you don't win the play, you're going to get assigned and exercised on the contract, hence why my account is down $44,000. That's actually not real. This actually doesn't exist because, as you can see, my portfolio value is $593.96, actually $913.96, because we had got the $400 in credit from the credit spread because I accidentally played two of them. I meant to only play one and collect $200 of credit. Yeah, and then minus the $20 exercise fee. That's how you get the $593.96. And then this will just clear up whenever it's ready, but you'll just, oh wait, we got to go into history. And we go down here. So this is where you can see this. So we got assigned on the 225. So we owe for $45,000. But we exercise this contract. So we have $45,500. But we have to sell these shares for $225. So that's why we lose the $500, is because we only got $45,000 from this, from our $45,500 exercise. And then you have to add the $20 exercise fee. And here's the original play. This is the $200 in credit I picked up, and then I accidentally bought this one because I didn't even know this one went through. So that's why this play is such a big loss. I've lost like $100 or something, which isn't too bad. I'm really not worried about it. I'm kind of upset I played two of them because I didn't want to, but I was just like, let it ride. Let's see what happens. Either make 200 or lose 50. So I just wanted to get that out of the way. When you do a credit spread and it doesn't work out, you're not freaking out about my account's down $44,000. I owe Robinhood $44,000. No, you actually just owe him whatever minus your credit. So the whole play in total would be $45,500. I collected $400 in credit, so you just minus that from the $45,500. That's $45,100, and then you minus the $45,000 assignment because you lost those shares, and that's where you get left with $100. So don't try to overcomplicate that. That's just simple math, and that's just how credit spreads work. If HD would have went down, I would have collected the $400 in credit. My account would have been fine. I wouldn't be down $44,000. I really don't know when this is going to clear up. I've heard people say that it takes like a day or two for this to even clear up. So I don't even know if I'm going to be able to trade on Tuesday. But yeah, I guess we'll see. But I know for a fact I don't owe $44,000 because that would be insane. Owing Robinhood $44,000 off a $100 play. Could you imagine? That'd be crazy. But let's get into the play that I did. This was actually a Colt play, and I thought it was going to be really good. I usually don't play the Colt plays unless I feel like they're actually going to hit, but Home Depot was trading at like 228.82, and it had been going up a lot, so we were expecting it to bounce down back to 226, so we sold a credit spread, which I'll show you guys how to do a credit spread right now. So this price was down here at like 228, or actually I think we bought it at like 226. So this 225 was in the money and the 227 was out of the money. But essentially all you do on a credit spread, it's just like a debit spread, but the opposite. If you've seen the debit spread video I made, you sell the contract that's more in the money, and then you buy the contract that's farther out of the money. So when we bought this play, it would have been more like this. It would have been like sell the 230 that's more in the money, and then buying this out of the money 232, and then you collect a pretty decent credit. But you have that assignment risk, and then also the risk of getting your account margin called and not being able to trade for a day or two, which really sucks. I'm really hoping that doesn't happen because I love trading too much to not be trading. So yeah, when you're doing a credit spread, you're selling the more in the money and buying the more out of the money so you can collect credit up front. But then you would do this order, you would collect this $139 in credit, but you would need the collateral to do this. And right now I'm down $44,000, so I can't do anything for a while until they fix this. But you had the $250 in your account, you'd be able to play this play. But you wouldn't even need $250 in your account because you minus the $250 from the credit you're getting. So we would need more like $110 to play this. That would be our collateral because we collected $140 in credit up front. And it's the same thing with the put side. If you thought the stock was going to go up, you'd be able to sell the more in the money put and then buy the more out of the money put. And then you would be able to collect the credit up front. Yeah, it's really easy. There's really not much more to credit spreads because you get the money up front and you know your risk, but the only other risk to credit spreads is having your account margin called for like a day or two, but I think that's only on Robinhood. If you do it on any other broker, I'm pretty sure they clear it up like immediately. And you can also collect more credit up front. Say you wanted to sell this 232 and you thought for sure HD was going to go up. You could sell this 227.5, collect $40 more in credit, but your collateral would be $500, so you'd actually be risking about $300 on this play. So I don't usually play credit spreads like that. I like to keep the spreads really close together so you can get a pretty decent credit to collateral ratio. But I am honestly not that big of a fan of credit spreads. They're really good plays, and you can get some really good credits sometimes that are only like $20, $30 risks, but you got to snipe those. I really like debit spreads more, hence why I was able to get a lot better video out for debit spreads. Credit spreads are just kind of like, yeah, I think the stock's going to go maybe like a weekly credit spread. Like those are good plays. You're on Thursday and you just do a YOLO credit spread that ends tomorrow. It's really hard to find a good like over $200 credit spread that'll actually hit. So just be careful with credit spreads. Don't risk too much. Don't make your spreads too wide. And yeah, you should be good. The other thing I don't really like about credit spreads is that their percentages aren't that great. Like you're going to maybe get like a 400 or 500% play. Like I said, you could do like a weekly one, which is really nice. You can buy the contract on Thursday, and then Friday you either make $200 or you lose like $50 or $100. It just depends what kind of play you get. So there's a lot of strategies with credit spreads, and you'll just have to do a lot of research. Come back on our video. We upload daily, so you never know what we're going to be uploading. I hope you guys enjoyed this video. If you have any questions, leave them in the comments below. I'd love to answer them. Check out the Trading Fraternity channel. Be sure to check out the live streams. We're live Monday through Friday, market open to market close, and we'll see you in the next video.